Pillai, Managing Director and CEO of Cibil. Satish, broadly, this is the trend, and it's a very heartening trend that growth is strong and NPAs are not there and delinquencies is low.
Correct.
It's too good to be true.
No, it's true. It's like the conversation of a year ago. I think the outstanding question is how long does this growth continue? But I think the more pertinent question to ask is where is this growth coming from? So do you think that it's sustainable? Is it the same customers that we're going after? And that is not true. There is financial inclusion actually happening at a very rapid pace, even in the urban centers, even for consumption loans. So the customers people are going after and how they're leveraging actually is a positive story, right? I think over the last 8 years, it hasn't just been same person getting multiple credit cards. So the story is positive. The second thing is the type of loans. I think, the aspect around consumption lending is powerful. So you're getting this 10, 15, 20,000 rupee loans to be able to finance something that actually helps you. It's probably an impulsive buy on your part. And the way the banks and the NBFCs are lending in that segment, the structure that they actually follow, gives us a lot of hope in terms of the NPAs and delinquencies continue to stay low. And that's fact, that's bearing out so we actually monitor last quarter of last year, how many accounts got booked, how they're performing the first 3 months and 4 months, because that is material too. And we continue to see a lot of strong performance in terms of growth as well as low delinquency rates. So it's a positive story in terms of people paying back, awareness being high, and processor banks and lenders being such a good place that it actually is a great combination where they're able to find the right customer.
But as part of the financial inclusion story, if the base goes up, right, more and more loans are given out and a lot of people come into the ambit of taking that credit, how do you manage delinquency risk? Doesn't that also go up? I believe the numbers have inched up just by a few basis points, 1% to 1.6%, but isn't that a risk?
Yeah, so if you look at, depending on the segment that you look at, but if it's about 14 million people are applying for loans every month. And if it's 14 million people, out of that about 20
banks and NBFCs and fintech companies.
Everyone, across million. All, including public sector banks, rural banks, all of them.
So 1.4 crore borrowers come out every
month, right? So there are 4,000 people applying every second right now in India. So that is a big change from India.
4,000 people have applied as we speak.
Absolutely, absolutely. And the beauty of 30% of them probably already got disbursed the loan or at least approved the loan in the time that we are speaking. Wow. It's a fabulous change, right? But the interesting story and inclusion is about 25% of that 14 million, 1.4 crores, brand new to credit. They did not have that. And that number doesn't change much, right? It used to maybe 30%, is 25%. You pick a product segment and you'll see a lot of people getting included into credit because it's a replacement of cash. And that's actually happening. So there are new people coming into credit every second. So 25% of that 4,000 while we are speaking is brand new to credit. And it's not just a two-wheeler for a 21-year-old. It's somebody actually buying a TV. It's all age groups. And that continues to be a fabulous story. And the interesting thing is that NPA of those segments is pretty much the same as every other segment as a whole. So it isn't as if it's primarily risk. And I think I give a lot of credit to all the banks and lenders out there. Two things, right? They've adopted technology in terms of the cost of acquisition in a massive way, infrastructure as well. But I think there's a great overhang of 2007 and 8. If you remember 2007 and 8, know what actually happened in terms of over leverage, and there's a overhang where you understand you do not want to repeat the same mistake. That helps you kind of make the cycle last a little longer. I think that's a powerful piece, right? People drive a lot of the policies in the end of the day.
But let's try and understand the nature of not just money coming in, or rather, people taking more loans, but the ability to pay back. As we understand, there are NPAs in the housing sector.
That's right.
Where are those NPAs concentrated? Is it the low ticket? Is it high ticket? Is it affordable segment? Where is it happening?
So first and foremost, I think affordable housing or low ticket housing tends to be traditionally riskier than, let's say, a high ticket. But that's not what's causing any uptick. A lot of this is structural. There are issues in the northern part of India in terms of capacity, in terms of issues, in terms of people not getting their houses. Those type of structural issues matter. Demonetization will have the biggest overhang, which is actually going to be in housing on the self-employed sector. And you see that. So the question is it driven from a supply side or demand side? A lot of this is the demand side of it rather than banks on the supply side having an issue.
If I look at the top 3 private banks in India, ICICI Bank, Axis Bank and HDFC Bank, nearly 60%, probably 55 to 60% of the total loan book is coming from retail. That's where the growth is and that's where the opportunity is. And when I look at those numbers, all of them are maintaining that we've got problems in a corporate book and no problems in a retail book.
Correct.
Will this kind of a trend continue? Because this has not been a 1-year trend or a 2-year trend. This has been a 15-year trend.
Correct.
Do you think in terms of growth and in the NPA levels, what the top 3-4 banks are maintaining, can they maintain that?
Yes, so I would say from a timing standpoint, probably 8-9 year trend. I think 2007 and 8 there were issues on the retail side as well. But if you kind of look forward, none of us are soothsayers, but if you see the practice, unless there is some level of external shock and systemic change, right, this should continue. And the only reason this should continue is there is a market out there that needs to be targeted, and you'll see the next 2-3 years, not just these banks but NBFCs as well, along with fintechs, changing the type of products that are offered, right? That itself is what has changed last 8 years. So if 70% of the growth is driven by consumption lending, which did not exist or exist in very, very small section 10 years ago, that is, we are evolving to the need of the consumer. Consumer doesn't want a loan for 3 years. What they basically want is, I need to finance this, and it's just for 3 months or 4 months or 8 months. So the product type is going to change, and that's going to last the next stage of evolution. So we're all responding to an empowered consumer. That's actually what the change is, which is what I think is going to drive a lot of
the person who has the cash but still chooses to take credit.
Yeah, it's about the beautiful way of using float, right? That's the essential concept of actually taking credit and using it in a smart fashion. So I think the parallel around this, and that's our job, to make sure there is awareness around it, right? So, and it's not about saying the Cibil is the reason you get declined for it, but there's a social capital that you build because of it. I think that's changing. You see a lot of public sector banks now talking about pricing home loans based on this risk of an individual, because based on the score of an individual. I think those are powerful things. You changes some of the mindset of the consumer, they get a lot more empowered to be able to make the right decision. And that's a beautiful thing, right? And I think the exuberance should not be irrational in terms of growth, but to answer your question, there is all banks and lenders are talking about 20-30% growth in terms of new customers coming in over the next 3 to 5 years.
You said that about 1.4 crore new applicants are applying for loans every month, right?
That's right.
So as we speak, 5 minutes, 20,000 new applicants would have applied by that ratio.
Absolutely.
What has been the acceptance and the rejection ratio? Because for me, that again is an indication of reckless lending versus careful lending.
So it's interesting. There are 2 types of things that banks will do, actually 3 segments that they see, right? Somebody they've never seen before, right? They've taken credit before, but not with them, right? That's new to bank. There's one which is absolutely new to credit. So we'll lease that out, that's a 30%, right? The segment which is known to them also is a big segment, like could have a checking or savings account, can you use that? So the approval rates are different for different segments. They will range anywhere between 30 to 80%, right? But to short answer your question, the approval rates are not 90-95. You'll tend to see around 50-55 on a whole scale basis, the approvals actually happening.
Only 50%?
Absolutely.
So 1.4 crore, only 70 lakh gets the final approval.
Exactly.
Okay.
Yeah, so and that number is, as I said, is a mix. So if it's a liabilities customer, it's a customer that has a checking and savings customer, the approval rate will be a little higher because you know them already. If it's somebody different that you don't know, you'll actually go through a process. Even if it's 2 minutes, you'll actually will be able to say, and you do say no a lot. Right? We are actually working with banks to saying, can you say yes more without taking any more risk? So the math that we add is saying, is there a margin that I can help you increase people coming in even now and reduce your risk even in the segment that you're getting?
It's amazing the kind of scrutiny that banks extend out when it comes to retail credit, and still we are sitting on such a big pile of loans when it comes to corporate credit. So is there a mismatch in risk management when it comes to these 2 classes? Because you said PSU banks do exercise regulations when it comes to mapping credit profiles, right?
Yep.
And you said do give credit to banks that they work in their processes.
Absolutely.
But we are still in a mess on the corporate side.
So I think it's more organizational. I'll give you an example of it. So if you start looking at the whole spectrum of lending, start from the joint lending group or microfinance borrowers, and you see them all the way to a largest corporates, right? I think the way underwriting is done, the way data is used is very, very different. It's very heavy on the micro side, but you start with a smaller ticket, the larger tickets it gets away from the data. So the position that we're making, to answer your question, if you start looking at micro lending, so they are like small total exposure, 5-10 crores of a company, all the way to 50 crores, there are massive challenges there. Wherever data is not getting used for a decision standpoint, it will take longer to be able to make a bad decision. So the answer to your question, yes, there are challenges in there, but I think the asymmetry exists because the information is not used. And I think that's the powerful game changer, especially in the micro and small. Large gets a lot of the attention, but I think the importance is actually in the small and mid. We are the land of small and medium enterprise. At the end of the day, it's going to drive all of our growth. That's the place that I believe that that's the next retail. That clearly is the next retail that banks are focusing on, have to focus on. Similar methodologies to be able to use for the small and medium.
How is the market share moving? Now you've said that 1.4 crore fresh applicants, 50% get yes or no. It could be 55%.
Sure.
who's gaining the lion's share of the market share of those approved accounts?
So it's the largest player still. There are fintechs coming in, there are NBFCs coming in segments. Everyone is doing it. It is broad.
There a market share shift? You know, the reason I'm asking this question is because, you know, the way stock market investors think that they bet on a large trend. PSU banks are losing market share, private banks are gaining a market share. That's a multi-year mega trend which will continue for another couple of years.
Correct.
Within the retail lending space, is there a similar kind of a pattern which is visible where fintech could be disruptive, where, you know, some of the companies which claim that they'll process your loan in 5 minutes, are they gaining more market share? What's the trend within this category?
So your point around time, huge impact on loyalty. So the faster they appear, then the chances you'll come back to you. The delinquencies are lower actually, we make a faster decision.
What is it?
Because you're able to say yes or no much faster. See, longer basically means in a lot of times you justify making a bad decision. But to answer your question, that is not specific to a lender or lender type. Private banks, new private banks, old private banks, NBFCs, all of them are transforming. The share of market around them is not shifting just because of that. There's nobody left behind. I think the most powerful aspect of fintechs is not necessarily them scaling and getting a lot of share. I think they're still new, but they're actually helping evolve the market to make sure they're all acting the same way. So this idea of there is no lender you'll see, including old private banks, who don't talk about 5 seconds, 10 seconds and a 5-minute approval rate. I think it's broad-based.
Is the sentiment though souring purely because of the news flow with regards to PSBs and some of the private banks as well, or does that not matter to a retail customer? It's about the quickest and the fastest.
It does not, right? The expectation of a consumer experience is today, if you go to any store right now, you would expect to get financing in 2-3 minutes. Forget a store, a dealership for a car. You're not going to wait for 5 days. You would have 5 years ago. It's consumer expectation that's driving it. I think there is a dichotomy in there in the Indian banking around large corporates and not. I mean, I think there's a whole lot of probably undue attention on the large side. Obviously, it's a big part of the balance sheet exposure for banks. But the performance on a mid and small is actually good. It's not that bad.
No, but is the process more efficient with, I mean, versus PSU banks versus private banks? Because I've had cases where people are like, it's too much paperwork in a PSU bank, I can get a loan in a private bank like this.
Correct, and I think that is changing as well. So if you see all the large ones right now, they are transforming as well. But yeah, that's traditionally been the story. You will actually not go for a low interest rate because the convenience is a lot more important.
Okay, appreciate your time. I'll just get fantastic insights from you.
Thank you.
It's just been such an enlightening conversation that thank you for telling us. Imagine as we speak, 10-minute conversation, 40,000 new applicants.
But not all of them have got it.
Exactly.
That's the key, and we can